dividend presentation. So I showed dividend presentation last week and completed about 60% because it was so long, about 50 slides. So I did not cover whole presentation. So I'll cover the rest. And I will go through the previous slides also, so those who missed, they can see what's going on. So let me start here. So analyzing last week's stocks and dividend and its effect on options and strikes. So when dividend is declared, then it has effect on options and the strikes. So it depends on whether it's a cash dividend or a stock dividend. So I will, through the charts, I will try to explain how professionals make money in the stock market, how they come in at right time, and before we even know it, they are there, or they are out of the stocks before we even know that they are out. So I'll try to show you different patterns and techniques I use, strategies I use. There's a lot more what I do, so I'll show you just, I'm showing you a little bit. It's not a complete story. I cannot explain in 15 minutes. So how professionals make money in the stock market. Now, as I've said before, fortune is made by mastering few techniques. So if we master few techniques, is enough, like 7, 8, 10, and we just repeat it again and again and again. Out of 10, 15, you have one of the patterns or the techniques you can use on a daily basis. So the stock repeats. Doesn't matter what stock it is, they show the same thing. So when the move is about to occur or is occurring, you need to spot the move and then make that decision and get in. Figure it out, where is your risk, where would you be wrong, so that you can ride the wave, and where you will be exiting. So two things needs to be determined right at the beginning when you're executing the trade: where you will be wrong, what the stock will do when you are wrong, and another thing, when you will exit when you are right, when the stock starts moving in your direction. So where will be your exit point? Because you don't want to hold it forever, especially in swing trade. Swing trading is about quick and fast move. It's a mix of day trading and investing, so it's in between. So for swing trading, you're looking for that move. The move comes within ideally the move should come within 1 to 5 days. What you are looking, the cap, that ideal chunk of the meat. If your entry is perfect, your trade should start showing profit right away. It's called instant gratification. So you should get instant gratification, and gratification should come consistently. So it comes when you master a few techniques. So this is my famous quote by Bruce Lee. As he said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." So you need to practice few kicks, not just one, just few kicks. Even if you practice one and master it, then just look for that technique. And when it comes, then you go for it. So this is perfect for stock trading. And the stock trading, as we know, is the hardest profession in the world. You're competing with millions of traders and experts with resources like Goldman Sachs. So in swing trading, we need to master the techniques which produces high and fast return. So we are looking for a return which is fast, so it should come within 1 to 5 days. That's the ideal, and the return should be high. So when you in swing, you can capture 5% to 10% move in the stock. It's possible. Minimum 3% is required. So minimum required move is 3% in stock trading. Swing is stock trading, and you can even capture 10%, 15%. So, but when you combine the swing move in the stock with the option, then the move is explosive. So it can be 40%, 100%, 80%. So your timing is right. You enter, the stock moves, it makes 3% to 5% move. The 3 to 5% immediate move brings the return of 40%, 100%, even 400%, 1500% return in options. And so that's the game. So and if your hit ratio is, win ratio is 70%, then the and consistent 40-50%, then your gains are far more than the loss you incur, even if you incur 100% loss. But you have to be consistent. So there are many techniques I use, many candlestick patterns, many chart patterns, and some of them are like breakout strategy, breakout reversal strategy. So breakout strategy is when the stock is breaking out of the resistance or breaking down below support. So we capture that. Breakout reversal strategy, the stock is came down to a support and now it's making its move up with big volume. So something is happening. So you capture that move. Opening range breakout strategy, which I use. So opening range breakout strategy is the stock is moving in a range. When the market opens, the stocks, it's like when the market opens, have you seen the horse race? I will send you the video. Recently I watched amazing race I posted on the Facebook. So when the horse racing starts, like 10-12 horses, you see how they move, and so, most of them, they are moving in a range. They are just moving, and then there's one just takes off. One horse takes off and it wins, right? So as soon as the market opens, your system you should have a system where out of 500 stocks, like I have 500 stocks in the basket, out of 500, I cannot watch all 500 stocks. So I have a system which tells me out of 500 stocks, which stocks are moving in the market early morning. So I keep an eye on it, and then I time it. Opening range breakout is you time the breakout based on your time frame you define: 15-minute time frame, 30-minute time frame, hourly time frame, 5-minute time frame. So I have a system where I set up that as the time progresses, the horses which are moving higher come in front of me. So the horse which is moving the stock within 5 minutes faster than others are in front of me, then I say no, 5 minutes is not enough, right? Because initial buy orders from last night. So I say, okay, let's say 15 minutes. So I put the 15-minute limit. Then I say, okay, let me see the 30-minute limit. So I put the 30-minute limit. When I put the 30-minute limit, then I know that only few of them are moving. Others are behind. They just move up and now they are down, or they're not moving. If they move, they will come in front of me. So this is the opening range breakout strategy, and I apply it and I send the alert, and you see it right in front of you every day. So opening range breakout, and then I combine opening range breakout with the gap strategy. So opening range can be applied to any stock. Like for instance, the stock was closed yesterday at 100. It opens today at 100.05. There's no gap, and then it moves up. So you apply opening range, and then you capture that. But the gap is the stock opens at 100, closed at 100 yesterday, and opens at 102 today. So there's a $2 gap. Now, what is the chances that 102 open and then it fizzles out and then it comes back to 100, or it could go to 98? That reversal can take place. So that's when I apply my gap strategies and combine it with opening range, and I capture the move. So if the stock gaps up to 102, then I start watching on my 5-minute time frame and say, okay, if the stock opens at 102, is it going to go up or coming down? So I try to figure it out, but it will continue up. So if it continues up, then I buy calls. I know that if it hit the resistance and it's coming down, then this gap is fading. Then I buy puts. But and the same thing is on the reversal of the gap up and gap down, on the gap downside. So there are four strategies on the gap side. Gap up, the stock gaps up and continue going up. The stock gaps down, continues going down. The stock gaps up and reverses. It hits some resistance and then the sell-off takes place. So the gap, the news was not worthy for the stock to continue going up. So there were sellers waiting for this news to get rid of their holding. So the stock gaps up at 102. There were sellers waiting. They sold it. They just wanted to get out, and so they sold. Gap down reversal. The stock gaps down right at some support on a news, earning news or any bad news, and it gaps down to some major support. So when the stock gaps down at major support, the big guys come in and they start buying it. So you have to figure out if the stock gaps down, is it going to reverse? So I look at it on my 5-minute time frame, 10-minute, 15-minute. I start watching, and I apply the opening range strategy and I capture it. So I'll show you explain you the last week's trade, which we did on JPM on a gap down. So, okay, now this is advertisement. So for those of you who are not my members, Swing Option Service, you can take a trial offer for 14 days. So it's only $1. But I am only looking for selected people who are not just looking around. I canceled 3 subscriptions last Friday. This Friday I canceled it. 3 people joined this service for $1, and I immediately found out that they are not serious. So I gave them their $1 back. I said, please keep your $1 back. It cost me 30 cents in the PayPal, but I said, no, just take your $1, please go. I don't need your $1. You know, when somebody joins and sends the email, I find out immediately what I have a way. I don't know. It's my gut feeling. So all my members right now, they are really, I'm blessed. They are my longtime member. They are very nice. They stay with me in my thick and thins. So I just want to add one more member, suppose. So just like the other members I have, I don't want any member coming in who not like them, who are already there. So as soon as I find out that he is not like that, like the existing members, I immediately refund. Doesn't matter if it's $1 or $350. I just give them back. In fact, I have members who just say that if you get rid of this member, I pay for his service. So I'm very strict. So if you're interested, I'll show you what I have. If you're interested, then please send me email, and then I'll send you the link. Okay, so here is ANF chart. So ANF, we traded puts on ANF. So now look at this ANF gap down, right? So you will say, okay, it's gap down, and how you know it's gonna go up? So that's where your expertise come, that whether the stock is gonna go up or continue going down. So we bought puts on ANF. The volume, when in the morning when the stocks opens, then gaps down, you have to watch. You already know on the daily chart where the stock is, right? Gap down, you know, daily chart. You know your weekly chart, monthly chart. Monthly chart, you just forget it about in swing trading. You don't need it. Weekly, yeah, you can look at it to look at the overall trend. So on a daily chart, you see that. That's it. You know where it is. Then you have to switch on a shorter time frame, like hourly, 30-minute, 15-minute, 5 minutes. So I have 15 monitors at home in my office, 15 monitors. So one monitor is dedicated just on like 27-inch monitor on 3 charts. So on 3 time intervals, I just start watching the price action, and I'm looking at on a trade session, I'm looking at the price, how the stock is being traded on a 5-minute chart, and time of sales, and then I decide that it will continue going down, and we buy puts. So we bought puts on it, and we sold next day, but it continued going down. Show you. So this is what ANF is. So it just kept going down. It will continue. My target long term, if you're short on this, is like $6.30. So it will continue going down. So no point in buying it. Next is look at MOS. So this is the Moss, and I think I saw in the we bought Moss calls. So this is what I looked at. So the reason is simple. If you look at this chart, you can easily decide to go long on Moss. Why? Because look at these two candles, they were down bearish, right? So this was bearish candle. So this is another pattern I have. This is a bearish candle. This one, this tiny candle showed little interest. So, but this was not confirmation. This is not a confirmation that the stock will go up. But then when you see next day the move like that, and the tiny gap is closed, is almost taking almost here. So this is the move you're looking. And not only that, you have to, at the same time when the stock is moving, you have to see the other stock in the same industry group. So I look at Moss, I look at Potash, I look at AGU, other stocks in this category. All of them were moving. So I had to decide which one I take. I take CF, I take Moss, AGU, which one I take. So I decided I'll take Moss. So, and another reason was that it was moving, crossing the 50-day moving average. So I said, okay, I'll buy Moss calls. Here's my exit. Worst come worst, here is my exit. So somewhere here is my exit. So it depends how fast it's breaking it. If it's breaking this candle fast, I wouldn't wait even for this candle. I get out. If it holds this candle, then I can always buy back. So get out here, but it didn't. So it went up, and so it started showing this pattern next day, like not good on the sideways. So we got out with some profit, not a great profit, but we got out. So in swing trading or in any trading, you have to also evaluate your opportunity cost. So what is costing you? You have limited capital, so that capital can be applied to another trade. So if I know that there's another trade coming in, building up, which I can trade today or tomorrow, so I need to free up capital. So sell this Moss call, put this money to another trade, and take your money, whatever. Even if it's break even or slight profit, you take your money and put your money into another trade. So just don't stick around here. Now look at this NVDA. So we trade NVDA. NVDA is, I've been holding since $60, and I've been telling, a million times, NVDA is going to $200. So people come and issue bearish report, and then it does this thing, this boom, 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 but then it's eventually going to $200. No stock in the world can be controlled by just one person's report. So NVDA is going to 200, and look at this gap. We bought NVDA call. We had July calls, we had August calls, and NVDA will. I have members who hold NVDA shares. Sometimes they don't listen. I have to keep telling them it's $200 stock. They get out, then they regret, then they send email, they send message. One is listening right now. He's my friend. His name is John. So I don't know if he's holding NVDA, but I keep saying this is going to 200. So NVDA is going to 200. So you see this NVDA chart. So it's now 165. I have it in my retirement account. When we trade options, I got out somewhere here, 160. So on a pullback, we get back in at 160, and it's going to 200. So NVDA it's a great stock. Now this one, GWPH. GWPH doesn't have good options, but I buy shares. So when it was making its move, and it was around, I sent it twice. One time I sent it here, posted also on the Facebook, when it was making this move after this 3-day down, and then it was suddenly started moving up. That's where I caught it, and I sent alert, sold it here. Then when it was making this move, so in the middle, when it was crossing this, I sent the alert that GWPH, if you want to buy shares, you can buy. The option is crazy wide. So GWPH is in the uptrend. And look at this candle. When you see this candle breaking this resistance line, breaking this 50-day moving average, I mean, you can go easily go long, and you can buy. You don't have to buy tons of shares, like 1,000 shares. You can buy 50 shares, 40 shares. If it comes down here and hold, you can buy here, you know, and accumulate, and it's going up. Once it crosses 110, and it's going up. So right now it's on the sideway. You see it's sideway. So it's resting because of, so you see, if the professionals came and bought here in 1992, somebody bought it here. So so you know, it's resting. The new money comes in, then this is the resistance here. And when it breaks this, then it's going to this 200-day moving average. So stocks takes path, right? It takes it conquers one level, then it waits, then another level, then it waits. So it goes through the levels. So as the stock is traveling, you have to evaluate the levels and see, okay, is it worth taking, holding it, or should I tighten my stop, put some trailing stop, scale down? So you have to have some exit strategies. What is your exit strategy? All out, partial out, cover your costs, put some trailing stop, what is your initial risk? All of this goes into it to manage the trade. It's easy to get in, then what to do after that. Now JPM. So JPM chart, this is 11th of July. So I was watching JPM and before earning. So it was looking toppy. So I wanted to buy puts on JPM, and I have this chart of 11 July. So I wanted to buy puts before earning, but then I said, no, JPM is always, you know, it does a thing on earning. It gaps down, or it does move down, and then suddenly it moves up. So that's what JPM does. So if you know the past behavior, it could do the same in future. So I did not buy puts. And another reason is, even if you buy puts, suppose before earning, and the stock gaps down, but the option market is not open. The market maker doesn't open the option, and then you're left holding with the puts. By the time they open the option market, the stock is already on its way up. Then you're trying to figure it out. Should I hold my puts, or what I need to do? By the time you're deciding hold or not hold, should I sell, not sell? Instead of selling, you bought more. Now you are in more trouble, and then the stock is getting out of control. And by the time you take your decision, this, you know, you're already in red. You were in profit early morning, and then you are in red. So I did not buy puts, but I had it on my radar. So what happened on Friday? So this is what happened. As soon as the JPM was trading down in pre-market, so earning due to earning. So you have to watch the pre-market action, after-market action also on the stock you are interested in. If you watch and you understand the move which is happening, then you can capture that move in whatever direction you think. So when this JPM was gap down, I was watching it to buy calls, dot puts, because I know that, okay, JPM does the reversal. So as soon as gap down, I got the confirmation in 10-15 minutes of open, and we bought calls. I sent alert, right? JPM buy calls, and boom, 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 it reversed upward. And we got out Friday 15 minutes before market close. In fact, one member sent me email before I even sent alert. One member sent email to me that I closed this. So that was very good decision, his good decision, and I explained. The reason when the stock gaps down and you are in profit same day on a reversal, you need to take your profit, because tomorrow what the JPM could do is go on a sideway. It may take time. So this is a resistance. So on a gap down reversal, if it's up, you're in profit, you take your profit. So that's why I took the profit, and we also took the profit in Apple call 15 minutes before market close. Now this is force. So this is a gap down trade. So again, you see the same pattern I use: gap down, gap, gap down, gap up, reversal, down, up. So course gap down on earning. So again, I applied my techniques and I bought puts and alert, and this is what happened. The candle, you see this tiny candle became this big candle. So on the same day, we sold the course put and made money because of the move was big. So, so again, you have to, if you can master the gap down techniques or gap up, you can make money every day. There's something moving up and down. Walmart. So when Amazon announced wholesale food acquisition news, all of the retailers were trashed. So Walmart, on that day, we bought TJX puts and made money. So Walmart was again one of the stock which was going down, and then they came right here, they bought, but then it failed at this resistance and fell down. So when it was coming down, someone sent me an alert saying buy puts. I said no, you need to watch for this support. So this is the support. This is the Amazon news, Amazon day when Amazon announced. So this is huge volume. So this was a huge volume on the downside. So Amazon announced, then it went up, now it came down and it formed the bottom. So we need to know this bottom will hold or it will the stock will go up. So this is a double bottom pattern. So I didn't buy puts, I didn't buy calls, I kept watching. Now Amazon is the Walmart is keep going up. Just a second. Yeah, here. So you see it gap up, then it gap up. So in a double bottom, if the stock breaks this high in the middle of these two, then it's a new buy. So if it breaks 50-day moving average, Walmart is a buy, and here's this big gap to be filled. So Walmart is going back up. Okay, I have another program called 6-month coaching program. If you're interested in, you can send me email and I'll book the appointment, and it will start mid-August. I already have students. It's a 6-month coaching program, and when you book the appointment, we can go over the features and benefits of this program and we'll talk. It takes about 30 minutes for me to explain about this program. So if you're interested, please send me email. Noshi at Financial Markets Wizard. Okay, next. Okay, I have many charts, so this presentation is long. So Yelp, we bought Yelp. Again, it's the same pattern. It broke this resistance and Yelp broke above the resistance. So we hold Yelp calls and we are in profit. So I'm looking for 32 break. Once it breaks the 32, we'll see where it goes. Could go to 35. So I'm waiting for 1 or 2 days of up move in Yelp, and we will exit with profit. The next is, yeah, Yelp. So you see it moved up to 32. Now it's holding. It's just holding right at the line. I see here, line. See here, it's holding it. So once it breaks, right now it's in a sideways move. Once it breaks, we'll go towards 35. We capture that move and look at this big gap, right? So I'm looking to exit here on gap fill 34. DE. Now this is another trade we did, and we did two trades, calls and puts. So DE was coming down for whatever reason, and CAT was also pulling down. So Caterpillar was pulling down and DE was pulling down, but there was more selling pressure on DE. So we bought puts on DE for like $1.90, and there was a severe, this candle was severely bearish, and it came down to 123.30, something like that. It came down this here. So when the stock gaps down on a very, and close at, not gaps down, pulls back, and it closes at the low of the day, is considered bearish. So the stock should continue going down next day, very next day, right at the gate. But this didn't happen on DE. It started to, so I was watching, I didn't need to watch the chart. I was watching the price action. And the price action was telling me that there's something is going on. They want to buy D, support D at this level, not sell, not sell. So it was not, it goes down like 5 cents and then it comes back 25 cents. So what was it? 5 cents down, then comes to 25 cents. So I said I better sell my put. So I sold my put, and I also sent alert to sell and log gain, right? So we log gains, and then boom, 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 boom. It started moving up and it went to 125. And as soon as it started moving up, it was up like only 25, 30 cents. I sent the alert to buy calls, August 125, because I think now D is going up. So this is what happened next day. D went to 125.47. So I expect D to go up. And let's say if D doesn't go up, right? Something happened. So where is the stop? The stop is right here. If it breaks this level, I will reverse my position to puts. So I'll just follow, I'll take my loss. And I already have profit in D puts. My entry was very close to this red candle bottom. So if I'm in a profit right now, and if it reverses, I'll sell my calls and buy puts. But I don't think it will happen. It will continue. It will go up. This is FSLR chart. It broke the resistance. I don't have any position, but I'm just showing you that it broke this resistance big time. So FSLR could be going up. This is PayPal. We traded PayPal on this gap up. Again, there's another trade on gap up. It gapped up. It pulled back. So I was watching PayPal when it gapped up. So on Thursday. So it gapped up and it pulled back. And then when it went back above this line, I sent alert to buy calls. We bought calls, and next day we sold it with profit. So now PayPal, I want PayPal to hit this resistance line and hold it and then go up. This is CINA. We had CINA calls. Again, this CINA broke 50-day moving average nicely. So you can always take risks, right? So the stock is breaking 50-day moving average. You can buy calls. Your stop could be somewhere here depending on the selling pressure. So if the selling pressure is high, you sell. Otherwise, you hold it. And it broke this line. We sold it already. It was hitting this resistance line. So I sold my calls, locked my gains. Yeah, you say that now it's holding it, so it's just sitting there. So it will take some time for it to consolidate and move up. But in swing trading, you're not waiting for consolidation. You're not there wait for consolidation. You're not long-term investor or trader. So you just get out. This is Tesla. Again, people are bearish about Tesla. It did fall, but 303 is this level is the bottom, around 300, 303. So this is the bottom of Tesla, recent bottom, and it's going up. So Tesla will go up. It will cross this 50-day moving average, and it will come somewhere here. So Tesla is long, not short. People are still trying to short it, but it's not. It's going up, and you will see. Apple. So we bought calls. Apple. We had see 142. I've been kept telling you 142 is the support. We bought calls, we sold, and when the Apple was breaking this resistance line, I sent alert for September 145 calls, and we sold it on Friday. So this is what happened. I sold it, and when it was bumping its head towards 50-day moving average. This is LVS chart. We don't have any position, but it's holding its support level. So right here, you see support level. So it gapped down. Win was also down. So Win was down and LVS was down, and they both held their gap down level. So they may hold and go up. Again, I have a $1 offer. $1 for 14 days. So please send me email if you think you are interested. Please tell me a little bit about yourself, and I'll send you the PayPal link. Okay, next webinar is on August 16th, so it's after 2-week gap. Now let's discuss dividend. And boy, already 5:37. So dividend, I discussed about 60% of the slide last presentation. I have 40% left. So I'll cover the first 60% fast and then the 40% slow. So I'll go here. And then later, after 2-3 months, I can cover this. My name is Noshi Marcus. So, and this is live webinar. People think somewhere people say, oh, this is a recorded webinar. No, this is not recorded webinar. All my webinars are live webinar. I spend time in preparing the topics. So I'll go through the dividend, and then I will start. I will have this dividend presentation again sometime in a month or so. So if you missed it, if you are not interested right now, you can join again. So in this presentation of dividend, we'll talk about dividend and its effect on option prices and its strikes. So there are like about 50 slides. So we'll go a little faster because I've covered in the last week. So in this presentation, you will learn what is dividend, 3 types of dividend, components of cash dividend, benefits of cash dividend, dividend yield, calculating dividend yield, estimating future dividend yield. Thank you, Marcus. Please send me email. Future dividend yield, real dividend yield, dividend payout ratio, how to interpret dividend payout ratio, treatments of dividend, how do you treat your dividend, effects of dividend on option price and strike price, and then stock dividend, property dividend. There's so much to learn on dividend. You can Google and learn, or you can attend this webinar and learn from me. And thousands of topics I will continue teaching you for free every week. So this is all free. Nobody needs to pay anything. So what is dividend? So a dividend is a distribution of a portion of a company's earning to the shareholders. So dividend is like sharing your profit. So suppose I'm running a business, I make $100, I give out $80 to my shareholders, and I keep $20 for growth. So it's like that. So sharing your profit. So company shares their profit to keep the shareholders happy, and they keep some profit for investment and acquisition and growth purposes. Some, they don't want to share the dividend at all with the shareholder and their income as a dividend to shareholders because they need the cash. They say, okay, we may need the cash. So so we don't distribute dividend. Somebody asked me about YY calls. Why YY stock? YY, I think, is going up. It was on my radar. I missed it. I just kept watching on Friday. It just kept going. I think YY will go up. Netflix, I'm not sure right now. Netflix is kind of not my type of setup. Okay, so I answered 2 questions. So 3 types of dividend: the cash dividend, stock dividend, and property dividend. So cash dividend is when this company issues the cash to the shareholders. The stock dividend is it gives out new stocks to its shareholders. So if you have 100 stock, company issues 5% stock dividend, now you will have 105 shares. So it's simple. Property dividend is they share their property or inventory. So company don't have a cash, they don't want to dilute their position by giving you stock dividend. So they just issues property dividend. They say, okay, property dividend, they share their inventory. So they say, okay, we have this much inventory, we will sell whatever the proceeds we get, we will distribute it as a cash by selling that property. So let me explain cash dividend. So let's say the stock is XYZ, the price is $10, they issue 5% cash dividend. So you will receive 5% cash, but on the day the stock goes ex-dividend, the price could drop 5%. So in other words, there is no real gain at that time if the price drops the same. So you got the dividend, but you lost the value in the shares. But what happened is the stocks, which is the company which is issuing this dividend, usually it goes up the price even after it drops. Sometimes it doesn't even drop; it recovers fast. So you get that cash as an income. So people like to have 7-8% return on their investment, and as a cash, when suppose they retire, they want cash, monthly income, so they do that, and they participate in stock appreciation. So the stock is moving up. They bought the stock suppose at $20. Now the stock is at $40. They've been holding it for 10 years, and it pays consistent dividend. So they are having cash flow, and they are participating in the appreciation. So that's the purpose of dividend. So these are the two benefits of cash dividend. One is the regular income. So you get regular income every 3 months. The company issues dividend. You get the income, and you have exposure to capital appreciation. So if the stock is good, company is good, the exposure to capital appreciation. The $1 offer is the $1 offer for swing option service for 14 days, and then if you like, you continue at the regular price. It's not like $1 is forever. So if you're already a member, just forget about this $1 offer. So 3 components of cash dividend. Now we know there are 3 types of dividend: cash dividend, stock dividend, and property dividend. Now if the cash dividend, it has 3 part to it. So we need to understand these 3 parts. So then we will understand how to invest in those stocks which give you dividend. So one company is giving dollar dividend every quarter, and another company is giving dollar dividend every quarter. But are they same? Maybe not. So you need to understand. Maybe you need to seek help from professionals. So, but if you have the basic concepts, if you understand, then maybe you can do the research on your own and invest in the dividend paying stocks. Or if somebody is giving you advice, then at least you have the concept, so you can discuss with that person in a better way. So a dividend amount is a dollar amount per share company pays to its shareholders. So it's a dollar amount. So company say we will pay 50 cents per share. So that's the dollar amount for dividend. So 50 cents per share. So dividend yield, this is what you have to understand. So dividend yield is the return on your investment. So a financial ratio that indicates how much a company pays out in dividend each year relative to its share price. So meaning if one company is which is trading at suppose $50 and giving you $1 dividend, and another company is trading at $100 and giving $1 dividend, they are not same, because one company is trading at $100 and giving the same dividend of $1, another company is trading at $50 and giving $1 dividend. So in order to get the dividend from a $100 company, you have to buy a $100 share. So your return is only 1%, whereas a $50 company, your return is 2%. So so that's the difference between between 2 companies. So you have to see what is the dividend per quarter, multiply by 4, get that amount, and then divide by the current price of the shares. So I'll explain. So dividend yield is the ratio. So this is the formula for dividend yield. So dividend yield is annual dividends per share divided by current price per share. So if the company is issuing dividend $1 per share, let's say consistently $1 per share, quarterly basis, so it will issue $4 in a year, and if the current price is 100, then it means it's 4% return. For the dividend yield is 4%. So you just take quarterly dividend, last 4 quarterly dividend, and then divide by the current price. So that's dividend yield. So let's compare two dividend yields. So one is stock 1, ABC, current price $20. They give you annual dividend of $1 per share. Another company gives the same annual dividend of $1 per share, but the price is $40. This one is $20, this one is $40. For ABC, the dividend yield is 5% higher, but for XYZ, the dividend yield is 2.5% because it's trading at higher price. So it's the same company, same dividend yield, but the same dividend amount, but the yield is different. But it doesn't mean this ABC company is good just based on 5% return, because this XYZ may be experiencing tremendous growth. So this $40 stock can go to $80, whereas $20 stock remains at 21, 22. So you just cannot look at the dividend yield to decide on your investment. You have to evaluate the fundamentals of the company, the growth, uh, things like that, what the company is doing. So $20 stock stays at 21, 22. $40 stocks, by the time you realize, is trading at 100. So this could be the better stock, trading at $40, giving dividend yield of 2.5%. So you get 2.5% return, but you are participating in growth. Next is estimating the dividend yield. So if you want to estimate the dividend yield, you just take the last quarterly yield. So you go back and say, okay, what is the last quarterly yield? Multiply by 4 and divide by the current share price. Or you can take the last 4 dividend yield and then add it up and then divide by the current share price. That will give you the exact dividend yield. But if you want just estimated, then you just take the last quarterly yield. But the last quarterly yield could be higher than the previous 3, so it could give you the wrong figure. So you have to be careful. So the real dividend yield. So in this real dividend yield, you have to take the effect of your tax rate, federal and state, and whether you are reinvesting the dividend amount. So I did this little exercise. So let's say current share price is 100. You purchase $1,000, 1,000 shares. So you invested $100,000. Average quarterly dividend is $2 per share, and let's assume you held on for 1 year this investment, and your federal tax rate is 15%, and state tax is 20%, and whatever dividend you received, you reinvested it, which means you bought new shares. So you got the dividend amount, and with that dividend amount, you bought back more shares of the same company. So if this is a scenario, your scenario is that you want to just keep buying the shares of the same company through the dividend amount. So for instance, when you are investing through a mutual fund or through some advisor, they ask whether you want the dividend amount to as a cash or you want reinvestment. So you say reinvestment. So whatever dividend amount you get, they buy the same company stocks for whatever the amount you have. They just buy the shares and then reinvest. So since you have more shares, so next time when the company declares dividend, you get more dividend. Then you buy more shares. So your number of shares keeps going up, and then you are having more and more dividend. But at the end, when you take out your money after 12 months, then you have to pay the taxes on all your gain. So your dividend yield could be less than what you think you will get because of the effect of tax. So dividend, you got, suppose $2,000 per quarter because of $2 per share. So but it's not $8,000 because you're reinvesting the dividend. Your dividend you will earn is $11,500, but after tax you will get only $7,500. So because of the tax effect, you will get less, so 7,500. So dividend yield after tax, the impact is before tax is 11.53 and after tax is 7.5. So the point is, when you are investing, you have to see your tax situation also. So the tax, how you're managing your tax, so it could affect the profit. So for instance, I put money in the bank and at the end of the year they say, oh, I earned $300 profit interest. That $300 interest, when I report to the accountant, that's, you know, it goes with my tax. That $300 become like $220, so it's just useless. So dividend payout ratio. Now this is another thing which you have to understand when you are evaluating different company for your dividend purposes. So dividend payout ratio is the amount of dividend paid to stockholders relative to the amount of total net income of a company. So for instance, the company pays earn $100, and they say, okay, out of $100 we will give you $80. So that's 80% payout ratio. If they give you 100, they earn 100 and they give you $100 dividend to all the shareholders, they distribute, that's 100% payout ratio. So you have to evaluate the history of the company payout ratio. Is it consistent? They every quarter to quarter they give their ratio is same, like 50%, 60%. It's not like one time it's 80% and another time it's 20%. So if they drop from 80 to 20, you will get less dividend. So that will hurt your cash flow. So you have to see the consistency over the long-term period. So generally the company follows the consistent payout ratio. So the payout ratio you calculate, you take the whole dividend amount divided by net income. So in other words, dividend is $80 out of $100 income of the company. So the ratio is 80%. So generally the good payout ratio, they say, is 55% to 75%. So they say, okay, if the company is distributing the profit of 55 to 75%, it's considered good. So look for this ratio. So what does dividend payout tell us? It tells us how much return to shareholder. So out of $100 they earn, suppose they issue 75% ratio. That's the ratio, payout ratio. It means they're paying out 75% of their income to shareholders, and how much they are keeping for their growth. So 75% they issue as a cash, and 25% they keep for growth. So you have to see 25%. That's the ratio, and you have to see what is their long-term trend in the past. So the dividend payout ratio depends on the company maturity also. So the new companies, they don't give out dividend because they want to keep all the money for growth. So all the company, they just want to keep the shares, the cash, to reinvest for their growth. But the older companies, because they are mature, they don't have any new products coming, they have enough cash piled up, so they start giving you dividend. So dividend payout ratio also tells you the dividend sustainability. So if the company is paying out 100%, the ratio is 100%, then if they drop to 80, then you will think, okay, this time they dropped out, from 100 to 80. But if they are 50, 60, 55, 60, then they are consistent. So whether they have a high payout ratio or middle of the payout ratio. And then you have to see the long-term trend. Then you decide what is their long-term trend, how consistently they distribute the dividend, whether the company is in a growth phase, maturity phase, you like capital appreciation, or you just like cash flow. So all this goes into factor. So negative dividend payout. So negative dividend payout is that company doesn't have any cash. They lost this quarter, but they still pay the dividend. So when the company loses money and they still pays dividend, so they have to either give out the cash from the reserve, or they have to raise cash. So for instance, Apple has a bunch of cash. So if one quarter they lose and they still pays out dividend, it's okay for them because they can give the cash dividend from their reserve. So it's negative dividend. But if the company doesn't have cash and they are raising it by selling something, then that's and they want to give you dividend, because if you don't give you dividend, then all the mutual funds and other shareholders which rely on dividend will sell the shares, so their company will tank. So they come up with the solution. They say, okay, we will raise the cash, sell something, and give you the dividend, but it's generally a bad sign. So you have to look at that. So what to watch in dividend is, they say, I read that if the company is giving high dividend and they are buying the shares at the same time, they are trying to maintain their stock price. So that's not a good sign. So if the company is investing, what is happening, they don't have, what is telling is that they don't have any good ideas or any products or services. So they don't, so whatever cash they have, they distribute it, and then they want to buy their own shares. So it means the growth is halted. So that's not a good sign. So they're paying, suppose out of $100 they give you $80 dividend, and $20 they instead of on a growth, they are buying their shares back. So it's not a good sign. Now the market sentiment effect. So the market sentiment effect depends on the dividend, consistency of the dividend. So what the company was paying you, and now what they are paying at this quarter. So if the company was paying 50 cents per share and the current dividend they say 5 cents, the reaction will be the stock price will drop, because you were expecting 50 cents or 55 cents and now you're paying 5 cents. So they get out of the shares and they take the money and invest somewhere else. The example too is if they raise the dividend to 60 cents per share from 50 cents, so the stock will rise. People will want to buy the stock to cash that dividend, and they know that, okay, this stock is making money, and in future they will do that, because once they go to 60 cents per share, they have to maintain this level at least 50 cents, right? From 60 they cannot go to 5 or 40. So from 60 they can go to 65 or 55, but so it's a good sign. So what happens on ex-dividend date? So let's say when the company announces dividend, they say that on the record, if you buy shares, suppose till July 18th, you are entitled for the dividend, and July 19 is ex-dividend date. So if you buy shares on July 19, you will not get the dividend, only till July 18. So July 19 is ex-dividend date. So all the shareholders who hold the shares, they receive the cash, and those who are short, they have to pay the cash. And the stock price generally is reduced by the amount of the dividend. So stock price drops. So when the stock price drops and you're holding calls, your premium will go down a little bit. Sometimes it goes down big because of other factors. And if you're holding puts, then the puts value go up on the ex-dividend date. So you have to be careful. Sometimes we get caught on ex-dividend date. This is the website. You can note down dividend.com. It's easy to remember. You can go and do your research on dividend, and you can Google and find out if you're interested. So your dividend decision. So this is another thing. So you receive the dividend. So how you treat your dividend affects your the whole portfolio. So you treat dividend as an income, or you treat dividend as reinvestment. So there are two things. So I'll explain both scenarios. So when you're treating dividend as an income, meaning you receive $200 and you are using it for your bills on a quarterly basis, then you're treating it as an income. Or you're telling the company that, no, I don't want cash, just this cash, with the cash I just want to reinvest. So they reinvest, you buy more shares. So what you do affects. So far you have learned these 14 topics. There are more, so I'm explaining more. So far you have completed 14 topics. Again, I have 6-month mastering coaching program. If you're interested, please send me email. We book the 30-minute appointment and then we talk. And I have a $1 offer. Just send me email at noshi@financialmarketwizard.com. I'll send you email. I'll ask you a few questions, and then I'll give you the PayPal link, and you can join and try out for 14 days and see if you like. Next webinar is on August 6th, Sunday. Okay. Treating dividend as income. So if you decide to treat dividend as an income because you need cash, then this is what will happen. First of all, you have to pay taxes. So cash dividends are subject to taxes. So you receive $200, you have to pay tax. So let's say stock is XYZ, you bought 100 shares and your price is $10 per share. So your investment is $1,000. The company declared a big dividend, $2 per share. So you receive $200 in your bank because you hold 100 shares, so you receive $200. It's a big amount. So because you received this $200 and your investment is $1,000, so in fact your investment is actually $800 now because you got $200 back. So and you're holding 100 shares. So your cost basis is now at $8 per share because you got $200 as cash. But what happens when the company declares this dividend, the stock goes down by the same amount on the ex-dividend date. So the stock could literally drop $2 per share. So I'm just giving, this is extreme example. So the stock could drop by the dividend amount. So a stock can be trading at $8. So let's say tomorrow is the ex-dividend date. You bought the stock today just before close and it was trading at 10. You got $2 per share dividend, but tomorrow the stock is trading at $8. So in other words, you didn't gain anything. Your investment is same, and you have to pay cash dividends, taxes. But the thing is, the stock, when you're evaluating the company, the stock, first of all, the stock doesn't drop. Not all companies drop by the same amount. So that's one thing. Another thing is the stock, if its company is good, the stock rise again, back up, and then the stock can go back from 8 to 10. So in other words, you're or 12 or 14 or 15. So you're riding the appreciation and you're collecting dividends every quarter, but you have to pay your taxes. So this is what treating dividend as income. Now, if you treat dividend as reinvestment, so you say, no, I don't need cash, I want to buy more shares. So it's the same company, you bought 100 shares, $10 per share, investment is $1,000. Dividend declaration, $2 per share. Company said $200 we will give you. And after dividend is declared or received on ex-dividend date, the company price drops to $8. But you receive $2 as cash and you say, okay, I don't need cash, you reinvest it. So you will buy, with that $200, you will buy 25 more shares. So because the stock is trading at $8. So now this $200 will bring 25 shares. So 25 shares, meaning now you have 100 plus 25, you have 125 shares. So, and your cost base is $8. So now instead of $100 shares, you have 125 shares, and basically your investment amount is same, 1,000. You invested 1,000, but you're assuming that the stock will go up from 8 to 9 to 10. So when the stock suppose goes to 10 and 9, they declare another dividend, and then you reinvest, you keep reinvesting. By the time you realize your 100 shares become like 500 shares. So you invested only 1,000, you bought 100 shares, but now 10 years from now you say, oh, I have 500 shares, and the stock is trading, instead of $10, trading at $50. So you have more shares and there's more price. So you're rich. Okay, so this is another thing. We need to know the effects of dividend on the option price and the strike price. So if you're trading option, there's a Black-Scholes model which determines the stock option price, and it has 5 variables. So the model takes into consideration these 5 variables, and the variable is the option price depends on the stock price, the implied volatility at that time. So if the volatility is high, the option price goes up. If the time remaining in the option is more, then the option price is higher. So for instance, if you buy a December option, its price is, you pay more than if you buy option for August, right? So the more you buy time, more you pay price. And also depends on the dividend. So previous dividends the company has declared, The Black-Scholes model takes into that account, and the interest rate. So interest rate also plays a role. So these are the 5 variables which determines the option pricing. So I'll explain the effect of dividend. So effect of cash dividend on option price. So let's say you have to think that ex-dividend date, is it coming before expiry of the option date? So for instance, if you look at the August calendar, the August expiry of the option is on 18th of August. So it's the third Friday of the August where the options will expire. And if the dividend date is before 18th, so suppose on 17th or 16th, if you have option and you exercise your option and buy shares before expiry, before that expiry, you will get the dividend. So if the dividend, in other words, is ex-dividend date before expiry date. So if the ex-dividend is on 17th or 16th of August, so you have to take care of your option because the dividend is before the expiry. So you cannot wait till expiry date of the option to exercise your option, because you say, okay, the expiry date is on 18th of August, I can exercise my option on 18th of August, but the dividend date is on 16th or 17th. So you won't, even if you exercise your option, you will not get that dividend. So you have to keep in mind when is the ex-dividend date. And do you own in the money call? So in the money call you can exercise, meaning if the stock is trading at $100 and you have a 90 strike, so in other words, you can call. In other words, you can buy, you have the right to buy the calls at $90, right? So if you have the right to buy at $90 and the stock is trading at 100, you may want to exercise your option. So that's another thing. And you can exercise early to capture cash dividend. So suppose expiry is on Tuesday, the ex-dividend date is on Tuesday, you can exercise your option on Monday to capture that dividend. So you call your broker and you say, okay, I'm exercising my option, I want to buy shares, so on Monday. So you buy shares on Monday, you will get the dividend on Tuesday because ex-dividend date is on Tuesday. So you have to keep in mind all these 3 variables. And you have to know that cash dividend on option price, what happens is if the dividend is kind of bigger than what they expect, the call premium drop because the stock price drop on ex-dividend date, and put premium rise on ex-dividend date because the stock drops, puts goes up. So that's the effect of dividend. So let's explain. We will have another 10 minutes of presentation. So let's explain this impact of dividend on option price. So let's say you own option strike price 90. So Apple is trading at suppose $100 and you have the right to buy at $90. So you own a strike 90 calls and expiry is in 2 weeks. So option expires in 2 weeks. Expected dividend tomorrow is $2. So because option is expiring in 2 weeks, so and it's deep in the money, $90 strike. So basically, the option will be this $10 premium you have. This is a $10 premium, and the delta will probably be 100. So in other words, for every $1 move in the stock, the option is moving $1. So the stock option is moving dollar to dollar. So again, you have a strike at 90. In other words, you have the right to buy at $90 with Apple shares. It expires in 2 weeks. The stock is trading at $100. The expected dividend tomorrow is $2. The option fair value is $10 because it's, the stock is 100, your strike is 90, 2 week delta 100. So if delta is 100, the fair value of option is $10. In other words, you can, if you exercise, you can buy literally at $90 Apple and sell right away at $100, you make $10, right? May have bought this call for $2. So there are two scenarios. There are many other scenarios. I'm explaining two. So impact of dividend. So explain the scenario. Let's say you do nothing. What happens? And let's say you exercise your option. Then what happens? Let's say you do nothing. You say, okay, I'm not going to do anything. So you don't have money to buy shares of Apple, right? A lot of people don't have money to buy shares. They have options and they do nothing. So and tomorrow is ex-dividend date. We know because Apple is giving $2 dividend, the stock will drop to 98. And because your delta is 100, the stock is moving, option is moving dollar to dollar, your $10 option will drop to $8. So you will lose $2. So in other words, if you know the stock is declaring a dividend and you don't have the money to exercise your option and you know the dividend amount is high, you need to sell your option and lock the gains or whatever. Don't wait. If you wait, your option price will drop for this simple reason that the stock will drop on ex-dividend date. So that's the lesson. We need to sell because we don't have time now for stock to recover. So your option will be trading at $8, and even if in 2 weeks the stock goes from 98 to 100 or 99, your option just lingers. So now another option is you can exercise your option. So you have the right to buy option at $90, and stock drops to 98, it's okay. You lose $2 per share, but you will gain $2 dividend because you bought the share. So you lose $2 per share, but you get $2. So net result is no gain, no loss. Better than doing nothing. So if you have money in your account and you know the ex-dividend is coming and you have in the money call, you can exercise your option. So you call your broker and say, okay, I want to exercise, because we do we have American style option where we can exercise before expiry. In European style option, you cannot exercise your option before expiry. You can only exercise on the expiry date. So that's the good thing about American style. You can exercise anytime you want. So you can call your broker and say, okay, I want to buy stock. So you give the money, you buy the stock. If the stock drops $2, it's okay, you get the dividend back. And if when the stock doesn't drop, you gain. And if the stock drops and then go back up, you still gain. So that's the point I'm trying to make. Now the dividend, the last part. So stock dividend is simple. It's not difficult. The stock dividend is when the company gives you stock instead of cash. So you hold 100 shares and they say, okay, we issue 5% stock dividend. We give you more shares. So your stocks from 100 shares, your stock will go, shares will go to 105. So let me give you example. So stock price is $10, outstanding shares is 1 million. So the capitalization, which is the formula of capitalization, the total market value of the company, is you multiply the stock price by outstanding shares. So stock price is $10, they have outstanding shares 1 million, the capitalization is 10 million. So that's the capitalization, the total value of the company is 10 million. Now they declare 5% stock dividend. When they declare 5% stock dividend, which means 1 million shares will become 1,050,000 shares. But it doesn't mean the value of the company is going up. The value of the company remains the same. It's just dilution takes place. So in other words, more shares out there. So in order for this capitalization to remain constant, this 10 million, the 10 million will be divided by new number of shares, which is 1,050,000. So when you divide this previous, suppose today at market close the capitalization was 10 million. Tomorrow they give you stock dividend of 5%. The stock will drop to $9.52 to maintain this capitalization of 10 million. So the same 10 million remains. Shares goes up to 1,050,000. The stock tomorrow will trade from $10 to 9.52. So the stock price will drop 5%. But what will happen when the stock starts rising from 952 to back to 10? You will have 105 shares because you've got 5 shares extra. You will have 105 shares, and now it's trading at $10, so you make money, and then you don't pay any tax. So it's a good thing when a company declares a stock dividend. You get bonus shares. Not doesn't happen anything to your portfolio right at that moment, but when the company stock price appreciate, you get, then your portfolio is increasing. So it's like bonus shares. Nothing happens at this time when you get it, but later, who knows, it drops 952 and then it closes at 966. So right there is 14 cents gain at 105 shares. So now you must have seen, if you're trading option, you see some weird strikes, and they on a trade station it says non-standard, and then you see weird strikes. So the weird strikes is due to stock dividend. The company has declared dividend and it has effects on option strikes. So let me give you example. So stock is XYZ, current price is $40, and they have strikes 35, 40, 45, as we know, a 5-point incremental strike. They could have 37.50, 42.50, 45, 47.50, but for simplicity, 35, 40, and 45 strike. And we know that each option contract holds 100 shares. So we know that. Let's say company declares dividend of 5%. So it declares dividend of 5%. Now it means that each option now will hold, instead of 100 shares, it will hold 105 shares. So they will have two different strikes. One is 35 strike, which will hold, for the new buyers, that strike 35 contract will control 100 shares. But for the old buyers, the one you bought before the stock dividend, your strike price will be reduced by this formula, 35 divided by number of shares. Your new strike will be 33.33 and 38.1 and 42.86. And when you see that, then it means, don't think you're getting 100 shares, you're getting 105 shares. So if you exercise this strike, suppose you have to come up with money to buy 105 shares. So you need to have enough money in the account to buy 105 shares, not 100 shares. And if you get surprised, suppose you exercise your call and you get surprised, you say, oh, I got 105 shares. So you have to say, oh, okay, because of that, or why your strike is suddenly in odd numbers. So this is what happened. You got this because of stock dividend, or all this. So why your strike is odd number, or when you're exercising, why I need more. The broker tells you that you need more money, then you say, no, I calculated 100 shares multiplied by this is this amount, and then he will say, no, because you're exercising your option, you're buying 105 shares, not 100. So all this needs to be taken into consideration. And older strike, what happened? Older strike disappear after expiry period. Then gradually they phase out. So as the expiry date passes, these strikes are no longer there. So try not to, if you are executing new trade, don't buy these, buy the regular strikes. So if you already have, then you have this, but new strike, you look for a standard. It says on the trade station, standard, non-standard. So don't go for non-standard, go for standard. Okay, so last topic is property dividend, and it's very simple. As explained, property dividend is they give you a dividend in the form of property. So they sell the property and then they raise cash and they give you the cash. So it's alternative to cash or stock dividend. They just want to make you happy. They may give you shares of another subsidiary company they have. They say, okay, we make you owner of another company. They can sell their physical assets and give you money. They can sell their inventory and give you money. So these are the forms of property dividend, which is, and this is not common. So common is cash, most common is cash, then second common is stock dividend, and third is property dividend. So reason for property dividend is they do not wish to dilute their current share position. So they don't have cash and they don't want to issue you stock dividend, because when they issue stock dividend, then they dilute, you know, the whole the capitalization, and they don't have cash. So they don't want to take this route. They take route of sharing the inventory, and they want to get rid of that whatever assets they have anyway. So they just say, okay, we make you happy and we share. So that's, I think that's yeah. Again, please send me email for $1 offer. If you're already a swing member, then this offer is not for you, and it's valid till tomorrow. And please tell me a little bit about yourself, what kind of trader you are, etc. And then we go from there. And next webinar is on August 6th. I think I won't have next week. And if you have any questions, you can send me email. And I have a coaching program for 30-minute call we can have and discuss. And it's a 6-month mastering program. That's it. So 1 hour, 30 minutes. Times 5 p.m. Pacific next August 6th. So keep an eye on the register. If you're registered already, you don't have to register again. You are pre-registered. But in case you cancel, then you have to re-register. And please tell your friends and others about the webinar. Please spread the word. Thank you. Bye.